Hello, everybody, and welcome back. What are the perspectives for Chinese equities after 2 difficult years and the reopening of the country? I talk about this with Elizabeth Kwik today. Elizabeth is an investment director, Asian Equities at abrdn. A warm welcome, Elizabeth.
Thank you.
Elizabeth, the MSCI China has given back almost all of its gains from the beginning of the year. So is the party over again for China equity?
It has been a very volatile few months. As you saw from the end of December until January, there was a lot of optimism in the market relating to the reopening. People were very excited about the recovery. But things have since slowed and we've seen a bit of volatility. Now, what has been the driver behind that? I would say that firstly, people's expectations regarding the pace of recovery has been very ahead of what we're seeing on the ground. This is not to say that there is no recovery underway. In fact, when you look on the ground indicators, when you speak to companies, we see that there is a consumption recovery underway, but it is at an earlier stage than previously expected. Household savings are also high, so we expect this to continue to support the recovery once consumer confidence is restored. But we do expect this to be a bit more gradual coming in the second half of the year and into 2024. The reason we remain positive is that the government hasn't relied on handouts to spur consumption demand. So, it's not very reasonable to draw parallels between what we're seeing in the West versus what we're seeing in China. But I would definitely not say that the party is over. I would say, in fact, that we are at the beginning of the recovery. So I would say that this gives us reason to be optimistic for the remaining of the year.
So you already touched the topic. China's reopening was one of the most important events in Asia in recent months. So is the resulting recovery already fully priced into equity prices?
I would say that it's definitely not priced into the equity market. If you look at where China is trading at the moment, very little of this has been priced in. In fact, the themes that have been doing well year to date, they have been more short-term thematic things, including anything relating to AI or ChatGPT or state-owned enterprise reform. These are the names that have gone up significantly. But if you look at the quality companies, those that are running good businesses and delivering earnings, they have a positive guidance and outlook for the year. Most of them have given up most of the gains that we saw with the initial reopening. So on a valuation perspective, we definitely think it's a good time to be looking for some of the best long-term winners.
As China's growth returns to pre-COVID levels, a weak dollar, inflation, and recession fears are weighing on sentiment. What does this mean for Chinese companies' profits?
I think one thing good about Chinese companies, and particularly those listed on the domestic Asia market, is that a lot of their business is domestic focused. They do not have as much exposure to foreign markets. We are also selective on the companies that we choose for this. So we could say that, the external environment globally has a slightly less impact on domestic Chinese equities. So for instance, whereas the rest of the world is seeing inflation rates in the high single digit, it's come down a bit, but still very high. In China, this is less than 2%. We're at a very different part of the monetary cycle versus the rest of the world, which means that there is also a lot of room for the government to step in with monetary or fiscal policy as they see fit. So in that sense, there is a lot more leeway and more levers at hand for the Chinese government and to support the domestic economy.
China is the export champion. So to what extent can the pursuit of self-reliance and more domestic consumption minimize the export dependency of the Chinese economy?
The export dependency of the Chinese economy has been gradually coming down, although they are still, active trade partners with Europe, the US, and the rest of the world. You can see that across most industries, many industries, their drive towards self-reliance, self-sufficiency has been underway for a number of years now. You can see this in things like renewables, for instance, their need for energy self-sufficiency, not to be at the mercy of other countries on energy. This has been underway for many years, which is why now in the renewable supply chain, China is, for instance, in the solar space, they're over 80% of global market share. So they are very much ahead of the curve in those areas, but also in other areas like healthcare, for instance, you can see that with many medical equipments, they used to have to rely on foreign technology, but these days they are able to generate domestic brands which can sell to the domestic market. So that trend is very clear, and we do see it across many industries. So the domestic market is becoming increasingly important, and they are less and less reliant on exports.
The real estate crisis in China seems to be far from over. So how much of a burden is the issue for the Chinese economy and banks in particular?
For the real estate situation in China, it is still a very important part of the economy. So it still contributes about 20% of GDP. The government's drive to deleverage the real estate market is ongoing, but I would say that it is in a relatively more stable situation than at least what we saw 1 year ago or 2 years ago. If you look at the percentage of real estate related loans on banks' balance sheets, so this includes loans to real estate developers, but also mortgages, both of this, the number for both of this has come down significantly since the peak about 2 years ago. So this is an ongoing process, and we still see, for small developers, there is still consolidation going on. But for larger developers, the sentiment is improving. Things are much more stable, and we are seeing a bit more pickup in terms of land sales activity and people's confidence in the industry. But it's definitely something that is ongoing, which we are monitoring.
The US chip ban is supposed to cut off China's access to especially semiconductor or high tech. So what are the short, medium, and long-term consequences for Chinese tech-reliant companies?
I would say this is related to China's need for self-sufficiency, which we touched on earlier. There's clearly still a gap in terms of the most advanced technology for semiconductors in China. And they are very much aware of this and have been putting in a lot of money, a lot of resources to develop the local semiconductor industry, not just in the last few years, but the process has definitely been accelerated with the heightening geopolitical tension environment that we're in. In the near term, I would say that for most of the equipment or uses for semiconductor chips, they do have relatively high inventory for the chips that they need or the capability to produce it locally. So that's not so much an issue in the near term. But when things move towards more advanced technology, which they are currently relying on imports for, only time will tell, how much they're able to catch up. But I would say it's definitely a strategic priority for the country, for the government, and they are doing as much as they can to close this gap.
The Chinese stance in the Russia-Ukraine war and the Taiwan conflict are unsettling the markets. So how do you deal with these new geopolitical risks?
When it comes to Taiwan, we take a more constructive view in the sense that when you look at the considerations that they have, the economic considerations, all the different countries who have vested interest in Taiwan, I would say that we don't think that it is likely to see any similar situation as we saw in Russia and the Ukraine happening in the near term. Naturally, tensions are high, and there is a desire to reunify, but at the moment we don't see this as an imminent risk. We do consider geopolitical risk generally, given that the way things are going. So it is something that we consider very much in our investment philosophy. When it comes to the industries that we invest in, we do consider, is it a sensitive industry? Is it a high risk industry? So it is one of, a key consideration, given that this will have, not necessarily an impact on fundamentals, but also on sentiment. So we do consider both of these aspects.
To what extent might the current geopolitical tensions with the US influence China's plans to open and liberalize the capital markets?
I don't think this has changed China's desire and plans to liberalize the capital market. They still want to, be able to have a more open capital flow in and out of the country, to be more, globalized. It is a bit more difficult given the current tensions between China and the US. But if you talk to people on the ground, if you talk to regulators, this is still very much what they would like to see. As China plays an increasing role on the global stage, the interconnectivity is very important. So I would say that it is something, I don't think they've changed their mind on this, and it's still something that they would very much like to see. But I think that given the environment, it's likely to be something that is gradual and done more carefully than, if things were much more friendly on the geopolitical scene.
So this was Elizabeth Kwik, Investment Director Asian Equities at abrdn. Thank you very much, Elizabeth, for being with us today and sharing your insights into Chinese equities.
Thank you very much.